Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 25th of July, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. Going to go for our usual regular run through here today. We'll take a look at the calendar, what we've had, what we've got coming up. We'll take a look at the macro fundamental, geopolitical, central bank earnings reports and factors that are influencing financial markets right here, right now, by looking at articles from the major news wires. And then we'll take a quick look at the chart, see where the opportunities lie going into today. So morning, guys. Morning, Stephanie. Morning, David. Morning, Jim. Feel free to say good morning if you would like. So let's have a quick look at the calendar. Nothing really significant from yesterday. Just jumping back to yesterday here, nothing really significant in here. We did get the S&P PMI data in here, global PMI data, slight beat on those. There's only a slight beat, not massive, but really the main impact was coming from the follow through from the overnight that we had on the data, the earnings data that we had out of Tesla and Google, Alphabet/Google. Looking into this morning, there's some slight disappointment here. German IFO business climate data in here, slightly worse than expected, and that's just added to the negativity. Alongside earnings reports, non-tech earnings reports out of Europe here this morning, also reinforcing a negative tone. Disappointing earnings reports out of Europe. We'll come to that shortly, which has sent European stocks even lower. They were down anyway on the back of the losses from the US yesterday, and those losses driven by the as I say, the Tesla and Google disappointment, big tech getting hit, and then it becoming a little bit of a contagion, moving across all sectors, and so all sectors moving lower for the most part, and getting hit. So certainly very negative. We did look at the charts yesterday. Don't want to blow my own trumpet, but we looked at the charts yesterday. I'll come to the charts, and I did do a measure down to where we could go, and even I said, I probably won't get that in one day. It's probably going to take a couple of days to get down there, but we did get down there yesterday. So the market, significant sell-offs, and pretty much hitting the targets from those kind of patterns that we had that I highlighted, and we'll come back to on the chart shortly. Going into today, the key focus is going to be on just under 1 hour's time. We get durable goods and GDP data. We do get PCE data, but it's not the important one. The important PCE data, remember, personal consumption expenditure data is the data that the Fed sees as their preferred measure of inflation in here. So that preferred measure of inflation, though, is the month-on-month, year-on-year data, which we get tomorrow. Get the quarter-on-quarter data today. GDP data today, though, usually you hear me say, well, GDP is not that important, right? And a lot of the time, because we're getting revisions throughout the year of data and updates on data. Now, this is probably the most important one we get on the from the GDP, and it's the preliminary data for the quarter-on-quarter here you see for Q2. So this is the first look we're going to get at the Q2 data, and Q2's only just gone. Sometimes we're getting this data months and months behind. So it'd be, we might have just had, say, for example, the final number for quarter on quarter for Q1, right? So that's like 4 months ago now. But this data in here is the quarter on quarter data for Q2, and the Q2 only ended at the end of June. So that's only 25 days ago. So this is like a very early read. So this can have a little bit more of an impact than when we get the update and the final numbers that we get as we go forwards, on which we will get for Q2, for example. But this is the preliminary first look number, and so this could be more important than normally. I kind of poo-poo the data and say that on the GDP, because it's a very big macro number that doesn't necessarily have a good reflection of what's going on right now. In this case, the first look preliminary number is more important. So we're certainly going to take a look at that. The quarter-on-quarter data in here expected at 2.0% for US GDP coming up in 56 minutes. We'll be watching that. Jobless claims not really a big deal in here. It's a weekly number, rarely impacts onto markets. So those are the two focal points going into today. Elsewhere, earnings, nothing really leaping out. We've had some already in here. Hasn't really stopped the downside, with markets extending still lower in here on the overnights. Even though we've had a sea of green mostly on these larger cap stocks, not actually helping stem the outflow in here. So market's still negative. AbbVie is coming. We haven't got that yet, unless it's come out maybe in the last 10-20 minutes in here, but I haven't seen that come out yet. 5 things that need to start your day, pretty much covering what we've already covered in here. Stocks sell off in here. Gathered pace Thursday. European stocks lower. French stocks on the verge of a 10% correction. Earnings disappointing in Europe. I've already spoken about that. Nestle, Stellantis, Kering, all dropping in here. Universal Music Group shares fell as much as 30%. So negative, negative, negative. Full shares plunged as much as 12% in pre-market as well. So all of this negative, negative on top of what we've already had. The first of those magnificent 7 stocks reporting a couple of days ago, and we saw obviously that Google. Alphabet, aka Google, and the Tesla numbers disappointing, and markets being driven down by that. And then I say this flurry of European numbers, and also Ford in here taking us lower this morning. That's seen a rush into safe haven, so short-dated bonds in here getting a boost from that, pushing higher. Excuse me. Next steps, next key moments for markets. We've already spoken about this. GDP data today, and then the PCE data tomorrow. And then the other thing on the overnights in here, China, but it hasn't really helped at all because obviously the global sell-off that we're seeing. But global China, we spoke about last week, already cut one of their interest rates. They cut another interest rate in here, unexpected lowered the rate on its 1-year policy loans. So another cut by China in here, trying to give support to the market, trying to give support to the economy, which is still floundering and hasn't really had a post-COVID rebound that the rest of the planet has had. So all of these articles I've got a string of articles, but they're all mentioning the same kind of stuff. Stocks extend lower, worries go beyond the AI trough. So it's not just AI now, going further. French stocks on verge of a 10% correction, disappointment after disappointment. That's the European stocks. Reuters morning big gross angst or air pocket. So is this just a dip, or is it is it going to be further? My view is just a dip. You buy into this if you're a longer term trader investor. Textiles been whacked stocks. Yen roars to a 2.5-month peak. Remember, yen going up as a safe haven. Tesla slumps as Musk tethers its future to delayed robo-taxis. S&P and NASDAQ close at multi-week lows as Tesla Alphabet weigh heavily. We've already gone through all of this. Futures nurse losses after tech jolt data awaited. That's the GDP numbers we're waiting for. Alphabet shares drop as investors wait for AI to pay off. Everything we've already covered. And here's the China article. China unexpectedly cuts 1-year policy rate by most since 2020. And another one on China. Central bank surprises by lending again at lower rates. On the overnights in here, we have Asian markets following their US counterparts down. The Nikkei down over 3% and the Hang Seng nearly down 2% on the overnights. European markets in here having already sold off yesterday with their US counterparts, still lower with those negative earnings numbers we've had out of Europe today. 0.6 further lower on the FTSE. The German DAX in here 1.3% and nearly 2% down on the French CAC. And on the US exchanges on the overnights in here, we're kind of stabilized. So not any further lower. We did go a little lower on the overnights. We have had a slight bounce off the lows on the overnights. So actually little changed on the overnights, but obviously got smacked significantly yesterday. Thank you, Stephanie. Great call. Yeah, it was a good call, actually. I will take it, when you got to take the acknowledgements when you get them right. But I when I said, if you remember yesterday, we'll look at it in a second, but I didn't think we'd go down to as far as we went down. Bond markets are not really moving much. We did see a slight push higher in bond yields and now back lower on the overnights as concerns, as a push into that higher prices, lower yields, as bonds being bought as a safe haven. That's on the 10-year there. And if you look at the US in here on the US bond market report in here, the market did go lower yesterday, but rebounding back higher on the overnights. We look at the short end in here, the short end actually went up yesterday. So the short end going higher in here with anticipation maybe of a more dovish Fed. That's not really, I've actually, let me just quickly reopen the Fed Watch tool. But the Fed Watch tool not really massively reflecting there. I did close it because it's just really sitting where it's been sitting. So we've got, the next, this is actually growing slightly higher in here. This is the chance of a 50%, not 50%, 50 basis point, 0.5% rate cut at the September. Oh no, so that's July meeting. Forget that. Here's the September meeting. So now we've got here, this is now you see for 78%. This is growing here. This is the one I was trying to look at. We now got, even a chance being built in, very slim as it is, that by September we get we've had 75 basis points lower in here, right? This is 75 down. Here's 50. So there's now 20% plus chance, 21% chance, 21.5% chance that we get 50 basis points. So markets kind of starting to price in a more dovish Fed in reaction to obviously the stock sell-off. Now the Fed doesn't usually react to the stock selling off in here, but maybe they could if we see other data starting to slow down. And now if we look at December, Now this here is now the chance of just one cut. Okay, this here is the chance of two cuts now, and now this has shifted. So now we're looking here as you go out to December now, we've got 55, 65, 67, 68% chance now of three rate cuts. So three rate cuts pretty much getting priced in now. This is three cuts up to from the middle column here to the left is now three rate cuts or more, and even getting priced in potentially for not necessarily four rate cuts, but a total of 100 basis points, even an outside chance of 100 basis points before the end of the year. Going back to my reports in here and taking a look at the indices, certainly seen obviously a big sell-off. We closed pretty much on the lows yesterday. We went lower overnight and a slight rebound. Now, on the reports, obviously you can't do anything but write about it being negative. We had a bear gap as well. I spoke about the bear gap yesterday. We don't get many bear gaps because the market's only, or bull gaps, we don't get many gaps in the market because the market only closes for an hour or over the weekend. But we got a gap yesterday, and that hour we were closed because of the reports, the earnings reports from Tuesday through Wednesday. So then both the NASDAQ and also wiping out these longer term trend line supports. The S&P trend line up from April, and similarly the NASDAQ trend lines up from April, wiping out those supports. They were important supports because they were previously defended here back in June. As you can see, the market went down to these, drawn off these points here. In April, May, and then going down and rebounding from them on a number of occasions. So plunging down through those trend lines. Now, as negative as that is, I do now think, given what we've seen on the overnight. Now, here's the measure. Do you remember we did the inverse head and shoulders? We had that kind of box for the inverse head and shoulders, kind of failed on the reversal of the neckline. And then I said, this would be the measure, this kind of area here. So the measure would be kind of pretty much looking at this kind of box here as a measure down. So the depth of that box measured down. So you'd measure the same distance down. And we kind of hit that. If you look at this distance here, and we measured it out yesterday and we were hitting it. So we've gone down and hit that target on the ES. And similar on the NASDAQ, it's done the same thing. There's that inverse head and shoulders. We failed exactly at the neckline on the NASDAQ. And then you've got the same kind of, just do it very quickly in here. You've got this kind of say box, approximately there, say, right? And you think that depth there extrapolated down, we've hit that target. And now the market's trying to form it looks to me now. Now, obviously it's in pre-market, right? So this is not necessarily super important, but it went down. That was at the end of the day last night. It's gone lower this morning, and it's gone lower again. So you've got this dip and bounce twice, dip and bounce, right? So there is a risk that this is forming a base. If we get back above, I think the first sign for me, 19,310. If we can get through 19,310, this looks like we could get a little bit. And don't be surprised if the market starts to rebound, you get a lot of value buyers coming in because there's a lot of value. Some of these stocks are off significantly off their highs. Some of these big tech stocks in here are down 10, 15, 20%, and they're looking like bargains. So watching out for that now. Similarly here on the S&P, there was the overnight. We've gone low, and you can see there's a double dip and bounce, and a dip, bounce, dip. And so you've got kind of almost like a double, mini double or triple bottom forming in here. Back up on the S&P 54, 90.91, it looks like a little base going in. So watching out for that. And if we get a little base go in and we go into the cash market open, we could see the value buyers coming in. This could shoot back higher. Now, doesn't mean that the bigger picture view is not still negative, but at the moment, given what, I was very negative, last night, but given the price action for this morning, I think there is a downside, a rebound risk, and just watching those levels that I've just outlined there, I think to the top side. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Oh, by the way, let me just, before I'd say that, if it goes lower, go with it, right? I'm not bullish by any sense. You can see from the report I'm bearish, but so if it just takes out the lows, it's going lower, right? It could easily be another % down today. But if we do get above those levels I just mentioned, watch out. Anyway, I'm going to go back to my sign off. So I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back to you with another bull versus bear webinar to close off today on TGI Friday. Bye.